Well, U.S. natural gas futures slipped to a 13-week low on Friday as a modest uptick in daily output, comfortable storage levels, and downgraded heating demand forecasts outweighed lingering cold weather concerns. Front-month futures on the New York Mercantile Exchange fell to $3.10 per million British thermal units, putting the contract on track for its lowest close since October 17. The market is now down for a third consecutive week for the first time since September, with prices losing roughly 29% over that period. Weakness was also evident in the physical market. Cash prices at the Waha Hub in the Permian Basin stayed in negative territory for a fourth straight day and for the seventh time this year, as pipeline constraints continued to trap gas in the largest U.S. oil-producing region. On the supply side, average lower 48 production eased slightly to 109.1 billion cubic feet per day in January, down from the record 109.7 billion set in December. Even so, near-record output combined with mostly mild winter conditions has allowed utilities to withdraw less gas from storage than normal. As a result, inventories are running about 6% above the 5-year seasonal average. Weather forecasts still show mostly colder than normal conditions through January 31, but demand expectations have softened. Total lower 48 gas demand, including exports, is projected to rise from 136.4 billion cubic feet per day this week to 149.2 next week and 151.5 in 2 weeks. However, demand estimates for next week were revised lower, undermining bullish weather narratives despite the coldest period still expected around mid-month. LNG feed gas demand has also cooled slightly. Average flows to the 8 major U.S. LNG export terminals slipped to 18.4 billion cubic feet per day in January, down from the record 18.5 in December, largely due to reduced intake at Texas facilities, including Freeport LNG. Meanwhile, despite the bearish tone, early signs of a potential bullish shift are beginning to emerge, although they have largely been ignored by major market participants so far. First, global gas prices are surging. European benchmarks are more than 30% higher on the week, marking the strongest weekly gain since October 2023. Colder weather across Europe is boosting consumption and accelerating storage withdrawals, with EU inventories now around 51% full, well below the 5-year average of 67%. At the same time, Asia is facing an incoming cold wave, raising the risk of intensified competition for LNG cargoes from China, Japan, and South Korea. Added to this are geopolitical tensions linked to unrest in Iran, which are increasing uncertainty around global LNG shipping routes. Second, the gap between depressed U.S. prices and growing LNG export capacity continues to widen. Since LNG exports were a key price driver throughout 2025, keeping Henry Hub above the $3 level, this divergence suggests the domestic market is increasingly oversold and vulnerable to a corrective rebound. Finally, the active gas rig count continues to trend lower. After peaking at 130 rigs on November 26, the count has fallen to 122, pointing to the risk of tighter supply in the near future. From a technical perspective, the February contract is under heavy pressure but approaching areas where selling interest has previously faded. The $3 zone remains a critical psychological and structural support area. A sustained break below the $3 level would expose the market to a deeper slide toward the $2.80. However, repeated failures to extend losses below $3 suggest downside momentum may be slowing. On the upside, initial resistance is seen near $3.40, followed by a more significant barrier around $3.70, where prior breakdowns in short-term moving averages converge. Momentum indicators are deeply oversold, increasing the risk of short covering or a technical bounce if bearish weather revisions pause or LNG flows stabilize. For next week, the market is likely to remain range-bound, with traders watching whether $3 continues to attract buyers or finally gives way under the weight of surplus storage and soft demand expectations. Don't forget to drop a comment, hit that like button, and support the channel to help keep this channel going. See you in the next one.